Well, folks, we just continue to get our flapjacks flipped just perfectly, don't we? Look at the public count here today. Ended up closing up almost $37,000. Another green one out there. So beautiful to see, even with all the drama out there and what's going to happen between the U.S. and China, and even with valuations where they're at. There's all this drama, right? So many things to worry about, government shutdowns, but market continues to just be strong like Donkey Kong. It's something else, right? Top of this video here today, we're going to talk about a couple stocks I bought here today. Put about, I think it was around $59,000 in two stocks specifically. We'll speak about those stocks, speak about why I went ahead and did it here today, okay? Then I'm looking forward to reacting to this one. And the reason being is this is an important person at JP Morgan Private Bank. So if you don't know, there's a big difference between JP Morgan regular, JP Morgan private client, and JP Morgan private bank. JP Morgan private bank deals with super high net worth individuals, usually 8-figure and up. And so I'm looking very forward to hearing anytime somebody from JP Morgan private bank speaks. I was interested to hear. The reason I'm interested to hear is not because I'm like, oh, they said this, so this is the truth, or this is the way it is. I'm listening because guess what? They're the ones talking to super high net worth individuals. And based upon what they're telling those individuals, right, you're going to be able to understand why people are doing certain things or not doing certain things out there in the financial markets at a particular time. Because high net worth individuals, a lot of them rely on a lot of these private bank folks for, should they buy this? Should they go stock? Should they go bonds? Should they go growth stocks? Should they go dividend stocks? Should they go real estate? All that sort of stuff, okay? Trade Tracker, Josh Brown buys more Netflix. We'll talk about Netflix, and then we'll talk about Zoom. These are two stocks Josh Brown bought. JB, I'm looking forward to kind of talking about my perspective on both those stocks. If Netflix is a buy here, if it's not a buy, if Zoom's a buy here, if it's not a buy. So we'll talk about that in this video here today. One thing only I need from you guys, please. If you could just hit that like button. That's all I need from you. That's all I need, man. Hope you guys enjoy these videos I produce for you on a daily basis. Additionally, if you're not subscribed here, you might want to be. YouTube will show more of my videos to you in the future. If you're not subscribed here, less of a probability. So you definitely want to make sure you're subscribed to the channel. Additionally, a few pieces of housekeeping here. I made this announcement last week. We're moving, starting January 1st for the private stock group, we're moving up to a minimum of $100,000 net worth in there. This demand's been ridiculous. Now we're up to 2,650 members in the private stock group. So demand's been insane here in 2025. I'm trying to limit that in 2026. Definitely trying to have less new members in the private group next year. It's just been out of control. So if you have less than $100,000 net worth, you'll want to get in there obviously here before year end. So you can apply with the pinned comment down there to join us in there. That's access to all my course curriculums, access to the private Discord chat, exclusive weekly videos, the moves I'm making, my $4 million plus Fidelity account, all that good stuff, okay? And obviously get around a lot of members that are higher net worth in general, right? And just today, we got our FedEx shipment in for $32,000. $32,000 worth of six-figure trophies just came in. Had to kick the Ferrari out to the driveway. Still got to get that mess put away. But anyways, it is what it is. If you ever want to follow me on X, by the way, I always have that linked in the description area of all my videos, including, look at this one. I said I spent $59,000 on two stocks. Guess what, too, man? People were guessing out there. We'll see who was right in the end. I don't know if even one person was right in regards to that, okay? Alrighty, guys. So what did I buy here today? Why did I do it? Well, I went ahead today and I bought a lot of Amazon stock. 245 shares of Amazon stock, $219.92 I paid for those shares. That's around a $54,000 move roughly in regards to Amazon here, which there's a few reasons I did it today. Okay, let me tell you the main reason I did it today, okay? Like, why not wait till a week from now, a month from now, right? Why didn't I do it yesterday? Well, okay, so here's the deal. Amazon earnings are set to come out, if I recall, the day before Halloween. Halloween is Friday, right? October 31st. If I recall, Amazon earnings are coming out Thursday, October 30th, after the bell, okay? Amazon's a buy right now. It's extremely attractively priced. I think there's a much higher probability Amazon will go up from here, going into earnings and maybe even after earnings, and go down. I'd rather just position in now. Maybe there's a chance Amazon goes down in their earnings, and I could say, let's say a week and a day from now, next Friday, let's say I could get Amazon at 210 or 205. I say, okay, guess what? I'll buy more shares. Amazon's a deal right now, so if you send it down to 205, 210, it's even a better deal, right? So I'll just buy more shares. You guys know I'm stacked up on cash right now, right? So I'm like, that's fine. We can go ahead and do that. if that situation happens. But one situation I don't want to happen is this stock come next Friday is 240, 245. And I'm still don't have the position in this stock that I want to have in this stock, right? With this move here today, now I feel comfortable with the amount of Amazon shares I own. If I look at all my portfolios in total, I'm comfortable. Comfortable, let me be clear about this. That does not mean I'm done buying Amazon. Amazon goes 240, 245. I'm going to probably continue to acquire the stock. My plan is on Amazon is to acquire all the way to 250. So I still have quite a bit between now and 250. Now there's a potential a week and a day from now it's 250, right? And I'm like, come on. But the moral of the story is here, like Amazon continues to be a huge buy overall in a stock that I need to continue to position into, but I feel comfortable. At least now I'm at a place where I feel comfortable with my positioning. Now there's certain stocks that I'm so heavily invested into, I can't buy more shares even though they're still a steal deal. Two stocks that come to mind, guess what they are? Meta. First and foremost, it's such an oversized position. The public count is ridiculous, right? It's like a 1.2 or $1.3 million position. That stock's on its way to 1,000 next year, in my opinion. And so, like, that's going to become even a bigger size position, right? So I'm already, I think, a little over invested in Meta. And another stock that comes to mind is, guess what? Another stock I think is going to go up considerably over the next few years, and that is AMD. But AMD, I got so many shares. I got so many shares in my private portfolios. I have so many shares in the public count. It's the second biggest position in there. Got AMD coming out of my ears. And at the end of the day, even if I'm so sure about a stock, which I'm so sure about Amazon, I'm so sure about Meta, I'm so sure about AMD, even though I'm so sure about a stock, I can never get over invested into them where it's an uncomfortable amount because I might be wrong. Maybe AMD's, what if AMD has some sort of technical issues with the 400 series and it completely messes up their launch for that, right? Like that could be devastating to the company and devastating the stock price. I don't think that's going to happen. I hope that doesn't happen. Lisa Su's a phenomenal execution and her whole team is there. But what if it happened? That's a huge risk. We could be talking about AMD go down like 50% in a matter of a month or two. Like it would be a disaster, right? Meta, I don't know. It's unrealistic, but what if everybody stops using Facebook and Instagram and WhatsApp? Like completely unrealistic, but what if it happened? Yeah, huge risk. And so I never like to get too crazy over invest in a stock, no matter how much of a sure thing I think it is. So in this particular portfolio, this is a private portfolio, by the way, I'm up to $110,000 in this. And so this is a 7-figure portfolio. It's one of my private portfolios, 7-figure portfolio, right? $110,000 position. I feel comfortable with where I'm at here. I would like to own even more Amazon, but I feel comfortable where I'm at. My hope is it goes down in earnings. I don't think it is. I think it's likely going up, and I'd rather position in at 219 versus 240 or something like that, right? And be like, I got greedy with trying not to buy now last week, blah blah blah, right? I got a lot of cash. We all know that, right? Next stock up here that I bought today is Cheesecake Factory. Bought another 100 shares of cake here, $55.73. Cake earnings should be coming out here in the next couple weeks as well. And so I just wanted to position into that one a little bit more there, $5,500 move in regards to cake. That this now puts me at a 6-figure position in that particular portfolio as well, right? And once again, that's a 7-figure plus portfolio. So I feel comfortable position sized with cake now in that particular portfolio. As you guys know, like cake's one of those I want to buy across portfolios. It's, in my opinion, is one of the most perfect stocks in the entire stock market. Like literally I'm getting a company that has unreal growth potential over the next decade between North Italia, Flower Child, expansion, plus the other concepts coming behind that. I'm getting it a great dividend stock too. It's usually got a dividend yield between 2 and 3% depending upon where the stock price is trading at. And I'm getting it at value prices. Look at the forward P of cake. What is a forward P of cake right now? I think the forward P of cake is probably 15, somewhere around there. Let's go ahead and take a peek here at the forward P of good old cakey. 15 forward P on cake. Like, come on. We're talking about a company that's got the next 10-year growth runway, like right in front of you. Like, it's not like it's hard to see and it's like, I don't know how they grow. Like, it's clear how they grow. Build massive amounts of North Italias and Flower Childs around the United States over the next 5-10 years, and you're going to grow immensely because those restaurants put up numbers. And they put up numbers from day one they're built. That's the other thing. They're now starting to put up crazy numbers from like their very like launch. The hype around those two brands is immense. So when I saw it with the Henderson locations, they opened up 2 locations in Henderson, kind of right next to each other, Flower Child, North Talia. Those places were packed right from the initial go. As soon as those doors open, busy as heck. And so it's just such a beautiful stock. It's such a moneymaker, man. So I love Cake. Alrighty, let's react to some videos up here, and then we'll talk some more about if Netflix, Zoom, some other stocks are buys or not.
And Schwab's Kevin Gordon. It's good to have everybody here. Abby, I'll begin with you. I mean, anything incrementally positive on the China trade front is going to be well regarded by this market.
Yeah. I mean, if we think about, we haven't had major down moves in like 120 days, something like that. It's been a really long time.
Yep.
We did have that negative 2.5% move that Friday where it was announced where this, this trade tit for tat came back. And I think, it was viewed as, okay, this is not only an embargo from an economic standpoint, but this is really hitting the AI trade, right? With the rare earth materials, like that's what was really unraveling the market. This was a double whammy in that it was going to result in really hard hit to economic growth, and then also the AI trade, which has been obviously a big component of the S&P 500's return.
So the market had turned its attention away kind of from trade, until the Friday sort of blow up in the market. So it's still out there, but the market feels like it's eyeing other prizes. Good economy, good earnings, and rate cuts. Is that right?
Yeah, I would say that. I mean, I think over the past couple of days, I'm sure we're going to get into this, that like you've seen a little bit of an unwind from a momentum perspective, and that's something that I think probably has something to do with the fact that we're...
Okay, so what is her take here? What is she telling the super high net worth individuals at the private bank, right? She's telling them, stay long the market and buy. She's still constructive on the market despite the year-to-date rally. So as simple as this, she's saying, hold your stocks, don't cash profits. That's what she's telling their folks, right? Global earnings growth into 2026 is driven by tech strength. Yes, that's true. That's just like factual. It's not really an opinion, right? Expect 3 rate cuts through to next year. That's interesting. So she believes basically don't fight the Fed. That's what she's telling her people, right? And so if you're wondering why does this market stay resilient, hey, you got somebody at the private bank dealing with all these high net worth individuals says don't sell, stay long. People are going to say, why don't you sell? The equity strategists saying stay long the market, buy the market, where they're constructive on the market. They think it's going up, right?
We're getting our first piece of government data in a month or so tomorrow. So I think there's some jitters around that. And I think it's also, October tends to be a little bit more difficult for the stock market. Next week, we have a ton of earnings, particularly from, the large cap tech and AI related names. And so I think there's a little bit of hesitancy to, into year end, like maybe take some profits of what has worked and rotate into stuff that hasn't. And that's why you're seeing defensives outperform in October.
What do you think?
Well, listen, I think
up with your view?
Yeah, it does. I think when you look seasonally, we're at the point of the calendar where you actually want to lean into what has worked. When you think about what are the 2 big risks out there, you bring up one, China trade. I thought it was very notable 2 Fridays ago on the Trump tweet, what didn't move. CNH, remarkably calm. That has always been a good barometer of when there's headline risk or real risk. We see headline risk, not material risk here. And then you think about what are the domestic concerns out there. We've seen this spat of bankruptcies, but high-yield CDX is still relatively calm here. You're not seeing the real deterioration of the credit markets, nor consumer stocks. If anything, consumer stocks may be reaccelerating here after taking the last 6-8 weeks off. So I'm still pretty comfortable with the view here. I do think there are some things to be mindful of. The banks have started to act maybe a touch weaker, but on balance, I still think we lean into strength here into year end.
I think Abby brings up momentum in the perfect way for us to discuss that.
I'll explain something. It's a little scary.
Because the unwind, there is a debate as to whether it's over or running, its course. It's on track for its first negative month in the past 7. It's on pace to be down 4 weeks in 5. You've had some pretty good declines in the names out of the MTUM. And Jeffries today asks the question, should it be bought? Morgan Stanley answers and says, well, it's only halfway there. What do you think?
Well, I think what's important is in this little 4 or 5 week momentum unwind that we've been in, the market's still up. Right. So we've had this rotational move, not this outright distribution. And you look at even yesterday as a good example. There was a point yesterday where the S&P was down 50, 60, 70 handles. Breadth was actually positive for much of the day. So you haven't seen what's become a little bit of a momentum shakeout really migrate to the other corners of the market. If anything, there are pockets that are getting better. Healthcare has inflected in our work. Discretionary is turning back up here. Industrials are still largely in pretty good shape. So I don't think the momentum unwind here is really infecting affecting the broader picture. And speaking of, when you look globally, China new high, Japan new high, Europe new high, you're not seeing it infect the global markets here either.
Kev, I'm glad that point was brought up about like healthcare.
So this is where things could get a little scary, downright scary for the market, and panic comes in. You see what I'm seeing here? We're listening to these Wall Streeters, not concerned, not phased at all, thinking bullish things into the year end, right? And maybe that does happen. Like maybe we just keep going up. Typically November is great for the stock market. December is great for the stock market. Usually two of the best months you'll get in the entire year are usually November, December. So maybe this plays out. But the scary thing is when these Wall Streeters start to go all to this bullish side and only see positive things, if all of a sudden you get caught up into something, like, man, things flip quick. And then they flip all their clients quick as well. And then you get a cascading of selling. And that's why you get this market so volatile now, where you can see, the Nasdaq go down 20%. And it seems like, how's it go down 20% so fast, right? And then you see it go up 20% so fast. Things shift quickly. But it's because a lot of times these Wall Streeters all of a sudden start to all get on the same side. So that's why I view this next, I would say 2 to 5 months as a very, I think, scary time for the short term of the market, just because I see some of these Wall Streeters kind of going on this bullish side, don't fight the Fed, these sorts of things. And I'm like, whoo, that in my opinion is a little scary, because if you get something to really shake things, never mind multiple things, all of a sudden these Wall Streeters start to flip, and then you get like no one's kind of prepared for that sort of environment, in my opinion.
Say, well, if healthcare and utilities and at one point staples were the three leading groups over the last month, that's not exactly the most bullish sign in the near term for stocks. How would you counter that?
Well, I would back it up to a little bit further, maybe over the past year or two, where utilities has really pulled away from healthcare and staples and not really being a defensive sector. It sort of shed that status, and I think a lot of that is presumably tied to anything power and AI related. So I think that to the extent you look at staples and healthcare as any kind of signal or yellow flag for the economy, I wouldn't take a month or a couple of months of some outperformance from healthcare, for instance, as some sort of yellow flag. I think that, this whole point about momentum and the discussion about it, I think is important, because this year's market so far, if you overlay it with 2020 into 2021, there are a lot of similarities in terms of a lot of the speculative froth and behavior that's going on in certain segments and certain pockets, but it's very confined and isolated to just those. To Chris's point about breadth holding up relatively well, even though we've gone through some of these bumps and rotations lately, you really haven't breached durably that 60% level for the percentage of companies in the S&P above their 200-day moving average. As long as you don't get those negative divergences where the index is moving higher but breadth is deteriorating, then you can continue and I think churn in a positive way, where this really just looks more like a consolidation over the past month, doesn't necessarily look as corrective.
So now something that I would say is good news if you want to really be bullish on the market, and if you think the market is just going to continue to roll higher for the next several months and we've got nothing to really fear about here, something really good news for you that I would kind of cling on to here is, think about it in this perspective. We know there's about $7.5 trillion on the sideline, right? A lot of high net worth individuals, funds, things like that are already arguably too high in regards to non-equity risk, right? So some people might be looking at it and they might be not as incentivized to sell right now because they're like, I'm already so cash heavy. Why do I want to sell when I already got so much over there? And that's a fair point. Even if I look at myself, there's been some times, recently that I thought about maybe selling something in my private portfolios, like, oh, let me maybe cash some shares on this or that. But what I always come back to is I'm like, I've already cashed some shares in portfolios this year. I'm sitting on $1 million plus of cash. Do I really want to cash out of equities when I already got a lot of cash? For what? I'm not the only one thinking like that. There's probably a lot of high net worth individuals, right? Imagine there's probably high net worth individuals out there right now with 30 million on the sideline and maybe 40 million in the market, and they're looking and they're like, okay, I could cash here, but do I want to? I already have too much over there in treasuries, and the treasury yields keep going down. So what you're going to be able to likely renew at next year is going to be significantly lower than, let's say you're on a 2-year, or 2 years ago you locked into a treasury, and that's going to renew here in the next few months. Like, you're going to end up having to potentially go into a treasury that's going to yield far less, right? Never mind 6 months out, 9 months out, 12 months out, probably even lower. And that's where you're like, do you want to be exposed to that, or do you want to just be in the market? Alrighty, let's talk some Netflix. Let's talk some Zoom if these stocks are a buy, and maybe drop a little gem here or there.
Out of the Nasdaq earnings reports, the stock is still trying to recover a bit from the sell-off. You took a look at this and decided you wanted to buy more.
Yeah, and it was an average up, so I owned it for a long time. The stock has had an incredible year, gave back a big chunk of the gain on the heels of earnings. It was a very strange earnings reaction, in my opinion, so I wanted to fade that. They had a long-standing dispute with the Brazilian tax authorities. I won't rehash the whole thing. What it boils down to is they paid a couple of years' worth of whatever that dispute was, 600 some odd million, and absent having made that payment, which was not in their guidance, they would have actually beaten the number. People just didn't seem to care. They used it as an excuse to sell. Now the stock is testing its 200-day moving average for the first time since April, and I believe we have that chart just so I can illustrate this point. I do think, here we go. I do think the buyers will show up here as they have in the past. I do think if it does break below, it'll be very temporary. I think the 200-day moving average.
Hold your horses, Josh Brown, JB, for just one flipped and flapjack in seconds, sir. Okay, hold your horses. Listen, in regards to Netflix, I graded Netflix's income statement. This was not some great income statement, ladies and gentlemen. Even with the whole penalty, fee, blah, blah, blah. At the end of the day, like, they've got some spending issues here. Look at the cost of revenues, what that came in. And that went up 20% on a year-over-year basis, far eclipsing revenues in general, right? Look at sales and marketing. Sales and marketing was up 22%. So, technology and development was up about 16%, so roughly almost in line with revenues there. So the way I look at it is Netflix has a little bit of a spending problem right now, right? That's just bottom line. Like, they have a bit of a spending problem. And so that is something that's hurting Netflix and make people a little fearful for a stock that has been on an incredible run. Like, look at it on the 1 year. The 1 year, the stock's still at 47%. That's incredible. That's way better than the market in general has done over the past 1 year.
Has worked like a charm in terms of a good opportunity to accumulate shares in Netflix the whole way up. And I just want to reiterate how good the fundamentals are here. 25% net margins. They actually raised free cash flow guidance to $9 billion for this year, up from a range of $8 to $8.5 billion. More importantly, they still have $10 billion left on their buyback authorization, which means as things settle out, they should be out there in the market sopping up some of that supply. They told us a significant increase in operating cash flow would come. And I think when you come up with, like, what are the most important companies in the market, in the world, in terms of being a platform for consumers, Netflix has over 300 million customers. They're in almost every country. This is probably one of the 5 most important technology platforms in existence. And next year, they take the fight to YouTube. They're bringing on podcasts like Bill Simmons and The Ringer. They'll probably do more of those. And I do think that this is a stock that should have a great 2026. So I wanted to make sure I own some more of it before we get there.
So Netflix is a beast. There's no debating that, right? The real debate really comes down to valuation. What are you willing to pay for this company given growth rates? Let's go ahead and let's take a peek here. So according to 1000X here, based upon what analysts are expecting, we're talking about a company with a forward P, we can call it low to mid 40s right now, right? About double where the market in general trades at, right? If you call it say Netflix is trading at a forward P somewhere between 40 and 45, it's roughly double what the market trades at. So the question is, can Netflix grow at least revenues and earnings per share at least double an average company, right? Well, if we look at current year expected, next year expected earnings per share growth, expected to be, mid to high 20s. It's very impressive. If we look at revenue growth expected here, I mean, we're talking about, mid-teens revenue growth, which is, that's more toward like triple an average stock in the market, right? So, I mean, if anything, Netflix is a buy right now, right? Like, I do not believe Netflix is the best, but let's play around with some numbers, okay? Let's do some projections here on Netflix, and we shall see where this company goes. So let's just run a base case on Netflix. So a base case on Netflix, I think a safe number to assume for their revenue growth on a base case over the next number of years, given that they'll probably go up on price from time to time. They got the advertising business. I mean, probably 14%. Now, let's assume they can get their expenses in a better place. Well, maybe they can have net income grow at a faster clip than revenue. So let's say like a 16% number for revenue growth on average. I don't know why I put 15 there. We're going to go 16% on average, okay? And we will go for a company growing, first off, Netflix is going to trade at a premium given the safety of the business model. Like people just stay renewed to Netflix over time. So you're going to give them some sort of valuation higher than an average stock just for that. But then you're going to get mid-teens, we can call it revenue growth and net income growth on average per year. I think for a company like that, I think a PE of, I would say 34 to 39 is fair. 34 to 39 for a company that's growing at those sorts of growth rates. So let's go ahead and take a peek here at what this base case says. So yeah, Netflix is a buy. Assuming this base case plays out, we're talking about a compounded annual growth rate, of 10% or maybe very low double digits roughly. Now, keep in mind, they could buy back a lot of shares, so that could help their earnings per share. So maybe that CAGR could be a little higher than where we're at here. And that's something you could run through advanced projections on Netflix. So, we have our projections and we have our advanced. So if you wanted to really go crazy with it, you could, run a whole advanced case on Netflix. But the moral of the story is Netflix a buy here. It's not a great buy here, though. That's the big thing. It's an okay buy. That's the way I describe it. Like Netflix would based upon the numbers I just ran there, Netflix will probably slightly outperform the S&P 500 and the Nasdaq over the next number of years, right? So just something to kind of keep in mind there. And then as far as the conference call goes, was there anything interesting that kind of happened? They talk about revenue and profitability trends. This is just does an AI summary of kind of what some of the important things were. Engagement levels are robust with significant achievements of TV time share. That's a really important metric for Netflix is like how much time are people spending on that, right? Really strong revenue growth they talk about. They talk about the Brazilian tax issue, which affected their operating income, which obviously we just spoke about there. Guidance and future outlook. Management maintains a positive outlook, emphasizing opportunities for profitable growth, especially given their current market penetration. Their plan to issue detailed guidance in the next call they're talking about. Opportunities and risk. Opportunities include expanding ad revenue and enhancing content offerings. Risks involve navigating complex tax landscapes. That's interesting. So that's interesting that they mentioned that on the call. Risk navigating complex tax landscapes and maintaining growth amidst competition. Competition I'm not too worried about, but navigating tax landscapes, that's interesting because that could mean they might have more tax issues in the future that might scare people. This whole Brazil situation might not just be a one-off, right? So something to kind of keep in mind there. But I love 1000X for, some of these features we have now, which is like AI, because I haven't gotten to listen to a Netflix conference call yet. There's a gauntlet of conference calls I'm going to be listening to over the next 30 days. But I like that you can get an AI AI kind of sift through and bring you out the most important parts that are going on there. Okay. All right. Next up here, Zoom.
Way back.
Yeah. Why are you?
I promised myself.
This romance?
I promised myself I would never do this again. So of course I did it. Here's the story of Zoom, as I understand it, and as I believe things to actually be. This is a company that we use at our firm, Ritholtz Wealth. There's an SEC regulation where financial advisors and other staff are not allowed to use their personal cell phones to call clients or to send text messages with clients. So everyone has to have their own phone number. And this sounds obvious, but during the pandemic, a lot of Wall Street firms got in big trouble for using their personal communication. Now, you can understand why. They were all sitting at home and nobody really had a plan. Zoom's got an enterprise business where they give you phone numbers that you can use. It's an app. All of our employees use it. So that's what got me curious. I wonder how successful this product is because that's our telephony provider. And they just announced that they now have 10 million users of Zoom Phone. The reason why this matters is because the problem with the stock for the last 4 years since the pandemic is that everyone looks at video like it's this commodity thing, like, oh, big deal, Microsoft Teams, Google Meet, it's all the same. The truth is, it's not all the same. When an enterprise adopts Microsoft Teams, the salespeople flip out because all of the customers they want to call on prefer Zoom calls. Zoom is...
Okay, listen up, folks. Listen up, ladies and gentlemen. JB has a phenomenal point here. I can speak to this. As far as like, if somebody, of our products, right? There's the Patreon, which anybody can just join at any time, right? It's always linked in the description. But as far as going into the private stock group, every single person nowadays is vetted. They have to get on a Zoom call. There's no like, you can't just get in the private group like, oh, just pay money and get, no. You have to get on a Zoom call with my team. You have to speak to them, make sure you're even a good fit. We turn away people all the time. Like all the time, like people are just like way too in the trader gambling mentality. It's like, nah, we can't help you. Like you're too far gone. Like you're not for our product, right? Go gamble your money somewhere else. But if we can't switch from Zoom, like everybody loves Zoom, and so the guys when they go to do those calls and vet people for the private group, like they got to do it through Zoom. There's no other alternative that people would know and like and just as easy and all those sorts of things. So what JB's bringing up there, that's a very valid point. And so a ton of companies and businesses out there rely on Zoom, and this, you can't really go somewhere else, or it's going to make the process for the other individuals much harder. Do you want it to be easier, or do you want it to be complicated, right? You much rather have easier.
Easier for everyone. So they sort of have an edge in a business that people think is commoditized. Okay, put that aside. If they can build out this enterprise business, of which telephony is only part of it, that's a really big deal. We have now adopted another product that they use called the Zoom.
Oh, by the way, you might say, why do we vet everybody for the private group? Shouldn't we just allow everybody? Oh, no. We used to do that way back in the day. Disaster. Nowadays, everybody has to get on a Zoom or you can't join the private group. No. Oh my gosh. Back in the day, we just let like anybody in the private group, and you had day traders in there. You had other people that were just gambling money around. It was horrible experience. Horrible. The Discord chat was trash. Bad, man. Bad. Then we said, okay, let's take this up a notch, right? Now we vet everybody that comes through, and it's so much of a better community. You get a lot of 6-figure, 7-figure, 8-figure type investors, right? People that have their head on straight or focus on the long-term investors. Oh my gosh. Back in the day, when we just let everybody in there, a mess. So if you ever wonder, like, why do we have to vet everybody? That's why. And some people are like, I'm not getting on a Zoom call, speak to somebody on the team. Fine, don't join. Like, I don't care. Do what you want. It's your loss, not mine.
Revenue accelerator. That's AI, note-taking AI, which of course other firms have, but it's becoming so good and so important to my organization that I can't imagine that's not the case for all of their other enterprise customers who are currently using it. I think there's going to be an inflection point where finally they're able to show some growth away from just the video calling. It could be this coming quarter. They're going to report on November 24th. Could be next quarter. Not 100% sure. But the great thing about Zoom is because there's no growth here, and it's just been kind of flatlining mid-single-digit growth, the earnings multiple is 18 times. I'm getting a discount, obviously, to the tech sector, but to the overall S&P, with the potential that they will figure out a growth strategy and it'll finally click. The company's got $8 billion in cash on the balance sheet. They can make acquisitions. They can continue to buy back stock. They can do whatever they want with it. And I think that the risk here is minimal compared to the potential upside if and when they actually hit it.
Why haven't you seen the growth then?
Real quick here, respect. JB starts talking about the stock and immediately it goes up. Immediately. That's actually pretty impressive, JB.
If they have this,
they can't
got some weight there, man. Got some weight.
Why are you going to pay 18 times for no growth?
I'll explain it to you. Because if and when the growth shows up, the stock will get a re-rating. Morgan Stanley just initiated coverage this week, and that was actually their argument. Basically, you're not paying a premium for anything here. You're paying a low multiple relative to other communications and technology stocks. But at a certain point, all of these other enterprise businesses that they've gotten into, if they can start showing actual growth, all of a sudden, this is a stock that people have to think about differently. I wouldn't be shocked if they finally post a growthy quarter or a growthier outlook. This could be $100 in the blink of an eye. Nobody owns it. Nobody owns it. The last thing I want to say here on the buyback or on the flexibility of having $8 billion in cash, one of the problems with this stock, they did all this hiring in the post-pandemic, like every other technology company, and they did something that was really generous for employees, but it screwed up the stock for 2 years. In other words, if they hired an engineer, they said, we're going to pay you $500,000. $200,000 of that is going to be in stock options. Then the stock falls 80%. So you either lose the employee or you top that employee up. They chose to top the employee up, give them another $200,000 worth of stock options. That stock option.
Oh my gosh, ladies and gentlemen. Ladies and gentlemen. Sometimes I forget Zoom used to be a $500 stock. That's insane. Like I don't even know what to say. Like I thought Zoom, like I was thinking like how high did Zoom used to be like 5 years ago? And I was thinking like 300. It used to be $500+ a share. And, you know, it's come off the bottom. The lows for Zoom was in the 50s, right? And if you recall, I even had bought some. I think I made a little bit of money and ended up selling out of it, if I recall. But, like, that's wild, man. I forgot it got all the way up to the 500s. But, yeah, what a brutal... That's one of the most brutal 5-year charts of an actual... Like, for any big established, like... Zoom's a great business. Let's be very clear. Their income statement, their balance sheet, their cash flow is very impressive. Great company. It's very rare you can ever pull up a 5-year chart for a stock, especially when you're in a bull market, right? Like it's been a 5-year bull market. Obviously, we had drama in 22, but at the end of the day, it's been an overall bull market. It's very rare you could ever pull up a stock and it's down 80+%, and it's actually a great company, right? That's wild. So the S&P 500 over the past 5 years is up 94%, almost a double up. And there's Zoom down 84%. But, I mean, at the end of the day, man, you buy a stock at a bad price, you're going to pay a big price. You buy a stock at a bad price, you're going to pay a big price. And that's why it pays to run projections. Because back then, Zoom was trading at a forward P like, oh my gosh, their forward P was so ridiculous back then. I can't even remember what it was. It might have been a 400 or something like that, right? And then all of a sudden those growth rates slowed in a big way and 80% down for the stock. That's where running projections, looking at the numbers, doing all that stuff, that's where it starts to come in handy, man. Because you lose 80% on a stock, especially if it's a big position, it's hard to come back from
compensation problem has been an overhang on this stock. A couple of quarters ago, the CFO came out and said, you know what? Wall Street is telling us to knock it off. We have to stop diluting the shareholder base. We have to start focusing on shrinking the share count and being a little bit more shareholder friendly and a little bit less employee friendly. I think that's a very smart decision, and that's another thing that could end up showing up if and when the next time they're able to report it.
Okay, so we'll watch it, and if anything, it's a little bit of the flavor, if you will, about what we have coming up today. We have a number of moves, and then we have a debate on...
So when it comes to Zoom here, let's go ahead and take a peek at valuation on this guy, okay? So he was talking about 18 times earnings, which, yeah, looks like right around 18, just under 18 forward P on Zoom. So now revenue growth of this company is rather slow. That's the issue. But JB's kind of thinking like maybe in 26, it sounds like maybe that revenue growth gets moving out of this, mid-single digit range. And yeah, if it does that, could be looking good here. But let's run projections on Zoom. Okay, so let's go ahead. Let's run some projections here. Let's run a base case on Zoom. So, all right, base case, I think base case 5% revenue growth is pretty fair, right? Now, net income should grow faster. They should be able to keep expenses really lean at this company. So I wouldn't be surprised if they do 5% revenue growth on average per year. I think they should be able to do 7% net income growth, right? So for a company that's kind of in that SaaS space, I think, my opinion is a 20 to 25 PE would be fair for a company. You know what? I think even a little bit higher. I think a 22 to 27 range would be more fair. I mean, the business model is sticky. It's a very sticky business model. And, if you can get 7% net income growth a year, that's good. So 22 to 27 is fair. That's not bad. You're getting a 13% CAGR there on the low end and 19% high end. Let's run a bear case on Zoom here. Bear case, I would say for Zoom is about 3% revenue growth per year. In a bear case would also be they can't get any net income lift. Like they're just stuck at 3% top line, bottom line growth, right? I mean, there you're probably at like, I would say a 16 to maybe a 21 P ratio, somewhere in there roughly. So, because like people just won't pay up. Like if you're only growing 3%, people won't pay up. So you maybe make a slight amount of money, but there's not much money to be made there. And that's not, over the next 4 years we're talking about, right? Now, a bull case here is, let's say they do have a nice revenue growth acceleration to, let's say, the high single digits up to like a 9% number. And maybe they get even some more net income lift, so they can do like a 12% number here. If SaaS space, sticky business model, 9% top line, 12% bottom line, I would say like a 29 to 34 P would be fair for a company like this at those sorts of growth rates. And let's see what we get for a bull case on this one. So there, the bull case looks amazing, right? Then we're talking about a CAGR 26%, on the low end and 31% on the high end. So this is kind of, I think, what JB's banking on, is that revenue growth is going to accelerate maybe to high single digits and get out of this like 4, 5, 3% range and push up to there. And if you can get there and you get some net income lift, you'll get a big valuation bump, and then you get a 20% plus CAGR on this baby over the next 4 years. So, but the question, are they actually going to be able to do that, right? And that is up for debate. I'm not convinced, but the moral of the story is I think this is very doable. I'm not convinced of this, but I think this is very doable, which gives you still a compound annual growth rate of double digits. I wouldn't be surprised at all if Zoom actually outperforms S&P 500 very nicely in the Nasdaq over the next 4 years. I wouldn't be surprised at all. Now, could it outperform that in a major way, like with this bull case? That's another question there, right? Alrighty, guys, I appreciate you joining me as always. Thanks so much for being there. Thank you for always smashing the thumbs up button, being subscribed to the channel, all that good stuff. Pin comment down there if you're looking to apply to join private stock group, private wealth group. And once again, if you have less than $100,000 net worth, you'll want to get in there ASAP, because we're about to make a move on that one up to 100K plus net worth to even get inside. Much love and have a great day.